Hello and welcome. In this recording, we are going to discuss Chapter 8 Equity Securities, Common and Preferred Shares. So, we are going to discuss these key important points. The purchase of common or preferred shares, represents an ownership stake in the company. And it differs whether you are buying a common share or whether you are buying a preferred share. So, we'll discuss more about it. The return on investment is tied to how well the company does. So it depends on the company's performance. So we'll understand what do we mean by company's performance. With an investment in preference shares, volatility in interest rates can have a big impact on the value of investments. So preference shares are very similar to bonds. So as the interest rate changes, the bond prices changes. That is what we have seen in the last chapter. In the same way, if interest rates are changing, preference share prices also change. So we are going to discuss more about it. However, as a creditor of the company, bondholders are given first priority in the event of bankruptcy. So shareholders, maybe preferred or maybe common, have the last claim on assets. So everyone else is paid before the shareholders. So the bondholders are paid, debenture holders are paid, and whatever is left, it comes to the shareholders. So this is something that we are going to discuss in details. So what is common share? Common share is what we discuss majorly on stock market. So if you see an Apple stock, right, mostly we are discussing about common shares of Apple. So common shares means by buying a common share, you get position of asset claims in the case of bankruptcy. So common share is nothing but ownership. So when you purchase an Apple stock, you become a part owner of the company. So you are becoming a proportional owner of a company in terms of shareholding. So if I have 1% Apple stock, I'm 1% Apple's owner, right? So what do owners get? So owners get position on asset in case of bankruptcy. So if the company closes down, right, it winds off. If Apple closes down, it winds off, it sells all its assets, and then from those proceeds it pays everyone before the shareholders. So it pays the bondholders, it pays the debenture holders, and whatever is left, it all belongs to the shareholders. So as when you buy a common share, you get position on assets in case of liquidation. Then you get rights to dividend. So if company decides to pay dividend, you have a right to it. Now what is dividend? When company make profits, from the year end profits, it can either decide to pay shareholders a part of it, that is called as dividend, or it may decide to retain those profits to grow its business. Those are called as retained earnings. So from company's profit, either companies pays shareholders a share, that is dividend, or it retains, or it does both. Some part it shares, some part it retains, right? So whatever portion is shared, those are called as dividends. So dividends are company's profit that it decides to share. Now dividends are not compulsory. So unlike bonds, dividends are not compulsory. Dividends are discretionary in case of common shares. So if board of directors decide to pay dividends, you have the right to get it. But if board of directors decide not to pay any dividends, you don't have a right to get those dividends. Okay, you cannot force board of directors to pay dividend. Next is evidence of ownership. So common shares you can buy in two ways. One is in your own name. So for example, I buy Apple stock in my own name. So what happens is, in Apple's records, I become shareholder of Apple. So my name is reflected in Apple's record. So whatever dividend Apple gives, or whatever stock split happen, or anything that happens, it reflects in my name. Okay. The second way to do it is street certificate. Street certificate means I don't buy Apple stock actually in my name, but I buy it in a firm's name. For example, I trade with Scotia. So I buy Apple stocks through Scotia, but those Apple stocks are kept in Scotia's account. So there are 10 people like me who have a Scotia trade account, and all of them have Apple stock. So Scotia Bank maintains a common pool of Apple stocks, and I get proportional ownership in that common pool. Okay, so my 10 Apple stocks are put in that pool along with hundreds of Apple stock that belong to someone else, and I get ownership of that pool. So in Apple's record, my name is not there. It is Scotia Trade that is reflected in Apple record. So whenever Apple pays dividends, it comes to Scotia, and then Scotia redistributes it to its shareholders. So this is how street certificate works. So you can either buy a stock in your own name, or you can buy it on the dealer's name whom you're dealing with, and then whatever dividends are received by the dealer, he generally transfers them back to you, and you're protected from dealers defaulting. Okay, we have discussed in chapter 1, there are insurances that protect you from dealers defaulting. Clearing and settlement. So share trading is majorly cleared and settled through CDS, Clearing and Depository Services Inc. Okay, clearing means identifying the parties, and settlement is actual transaction. So buyer and seller. Clearing means identifying who is buyer and who is seller, and settlement means buyer pays, so transfer of funds from buyers and transfer of shares from sellers. So that is settlement. Now there is a concept of trading units. So standard and odd lots. Standard means generally 100 stocks are considered as standard units. 90% of the trading happens in standard units, right? And you pay less when you buy shares in standard units. Okay, odd lot means anything that is not standard becomes an odd lot. For example, if I buy 100 shares of Apple, I am trading in standard units, so my commissions will be lower because there are a lot of people who are selling in standard units, right? But if I buy one Apple stock, then I am trading in an odd lot. I am not trading in a standard unit. In that case, my commissions will be higher. Okay, so that's the concept of standard lot and odd lot. So as a common shareholder, what do you get and what are the advantages of it? So you get potential for capital appreciation. It means you buy Apple stock at $200. In 5 years, it becomes $500. So you make money on that. You have right to dividends. If board of directors decide to pay dividend, you have right to receive it. Favorable tax treatment for dividends and capital gains. So interest is taxed completely. So if you receive any interest from bonds, it will be taxed. There is no exemption to it. But if you receive dividends from a Canadian firm, then there is a favorable tax treatment to it. So there is a certain dividend credit that you get. Okay, so you pay little lesser tax on dividends than on interest payments. How to do it, we'll discuss in the chapter 2, that is a module 2 of CSC, with the CSC 2 exam, not here. Okay, but you have to remember, as an individual, you have certain beneficial treatment for dividends. You also have a beneficial treatment for capital gains. Only 50% of capital gains are taxed. Then you get voting privileges. So you can vote while you vote to decide the directors, board of directors, you vote on audit, you can vote on major decisions that company make. So you have a right to influence the company by becoming a shareholder. Then limited liability, you are liable to only what you pay. So Apple stock I buy at $200, I'm not liable to pay anything more, right? I am only liable to pay $200. So that is limited liability. That is, my loss is at max $200, the share price I bought it at. My losses cannot exceed more than $200. Marketability, so shares can be transferred from one owner to other. So if I buy certain shares, then I can sell it in a secondary market. So shares are marketable. Right to receive quarterly and annual reports, so you as a common shareholder have the right to receive quarterly and annual reports. Right to question management at shareholders meeting, so you if you attend shareholders meeting, you can ask them questions. The risk is there is no obligation on company to pay dividends, so it may happen that they don't pay dividends for years. Little influence on day-to-day operation, so it is the management team that handles day-to-day operation, but they are overseen by board of directors. You appoint as a shareholders board of directors, so you have a say in major decision that company makes, but you don't have a say in minor day-to-day operation things that the company does. Prices are volatile and you can lose money. So share prices don't only depend on the company's performance, there are various other parameters that dictate the means dictate the performance of shares. So you may lose money. And you have the last claim on assets, so if the company liquidates, everyone else is paid before you, so it may happen that nothing is left for you. So that's a real possibility. Now, what is capital appreciation? Capital appreciation means you bought the shares at $100 and you sold it at $200. So this is capital appreciation. Now, why does it happen? So when you buy a stock, why does it appreciate? So one common reason is you have claims on asset. So if the company's assets increase, your claim on those assets increase, right? So if I have 10% claim on company's assets, the current assets are 100 million, so I have 10% of that, that is 10 million is my claim, right? Now if that asset goes to 200 million because company expands, so my claim will be 10% of 200 millions, that is 20 millions now. So one reason why share price appreciates is it increases in assets. Now why do assets increase? Assets increase because profits are increasing, so it is also related to profits. So share prices appreciate because of assets, because of profits, because of future potential of a company, and various other factors. But two major factors is assets and profits. Now, what is retained earnings? Retained earnings is when a company earns profit, it can reinvest into its own business. That reinvestment is called as retained earnings. So company decides not to pay any dividend but to retain it in its own business. That is retained earnings. And retained earnings helps company grow. So it is important for an shareholder to focus on retained earnings. What does the price actually depend on? It's a big thing, so we'll discuss it in module 2. Next is dividends. Dividends are not a contractual obligation, it is unless and until it is announced. So unless and until board of directors announce it, it's not a contractual obligation. So it's not compulsory for the companies to pay any dividends. Record date. So this is a very important concept. So I'm going to hammer it down a couple of times to make you understand it. So record date is the date on which the company closes its books for the dividend purpose. What does it mean? If your name is on the books of companies by the record date, you would be considered as person who is eligible for dividend. The reason is shares are continuously traded. So what happens if the record date is today and the closing is 5 o'clock, right? And I had bought the shares 1 day before, so means 2 days before, and the settlement is happening today. So I have bought it from my friend Andrew, right? So Andrew sold those shares to me. Now the record date is today at 5 o'clock, and I have actually received those shares, and the share in the company's records, my name has been replaced, means Andrew's name has been replaced by my name. So I am there in the company's record. So do I get dividend? Yes, I get dividend. Okay. But if Andrew had sold those shares today on the record date, would he receive dividend or would I receive dividend? So if Andrew sells his shares today on the record date on the stock exchange, trading and settlement doesn't happen till 2 days from that date. So even though he has sold those shares and have received them, technically the change has not happened. So Andrew will receive the dividend and not me. Okay, so this is an important distinction. So record date is the recorded shareholders on this date receive the dividend. Usually it is 2 to 4 weeks before the actual payment, because company takes time to bill out your checks and all those things. So it is generally 2 to 4 weeks before the actual payment date, and they will announce the record date. Come dividend is if you buy the stock, you will receive the dividend, because by the time trading and settlement happens, the time is before the record date. So you're secured in receiving the dividend. It is up to the second business day before the record date. I'm going to explain it, so don't worry. Ex dividend, if you buy the stock, you will not receive the dividend. It is 1 business day before the record date. So I'm explaining. So I'm opening an Excel and going to explain it to you. And this is an important concept. Most of the students have difficulty in understanding it. Okay. So let's say we are buying the shares on 12th of August. Sorry. So I'll just write down the date first. So 12th August is the record date. So the step 1 to do any kind of problems that they give in the exam on this concept is identify the record date. This is step 1. So step 1, identify the record date. Thing that you have to remember is it takes 2 days for the shares to settle. So if you buy the share today, trading and settlement happens on the second date. So today, tomorrow and day after. Trading and settlement happens day after. Okay. So if I buy share on 10th of August, when will the share settle? So the share will settle on 12th of August. So today and 1 business day and the second business day. So it will settle on 12th of August. So do I get dividend? Yes, I get dividend. So this is called as cum dividend. So the shares are trading. So the person who is buying is getting a dividend. So the shares are traded with dividend. Okay. Now, if I buy it similarly on 9th of August, do I get dividend? Think about it. Do I get dividend? Yes, because settlement will happen on 11th of August. So 9, 10 and 11, which is before the record date. Do I get dividends? Yes. So again, I am trading cum dividend. The shares are trading cum dividend. So concept for you. Record date is the date by which the company decides which shareholders are going to get dividends, which shareholders are not. Okay. If you manage your settlement before the record date or on the record date, you ensure that you are going to get the dividend. But if your settlement happens after the record date, you won't get any dividend. The previous person will get it. So if you trade on 11th August, do you get dividend? Think about it. When will settlement happen? Even though you have bought the share on 11th August, the settlement will happen on 12th and 13th. So 13th is after the record date. So your name will not be on the records. So you will not get dividends. So the share is called as ex-dividend. That is, the person who is buying it is not getting any dividend. If you trade on 13th of August, do you get dividend? No, because it is after the record date. Settlement happens after. So it is ex-dividend. Same way, if you buy it on 12th of August, it is also ex-dividend. Okay. So what do you have to do whenever you get questions? Step 1, identify the record date. Step 2, because you may forget the logic and all those parts. Step 2, ex-dividend is 1 day before, we'll say starts 1 day before record date. Step 2, step 3, all dates prior are cum dividend. And step 4, all days after step 2 are ex-dividend. So please take time, note down these steps because we are going to solve some numericals. So note down these steps. Step 1, identify the record date. Step 2, 1 day prior is an ex-dividend date. So 1 day prior, everything that starts from 1 day, all trades that starts 1 day before, right, all trade ex-dividend. 2 days prior is cum date. So means whatever before the ex-dividend date is all cum dividend, right? Everything after the ex-dividend date is ex-dividend. And then you can identify because they will ask whether the share trades X or cum. Okay. So cum dividend, if you buy the stock, you will receive the dividend up to second business day before the record date. If you buy the stock, you will not receive the dividend. It is generally 1 day before the record date. So let's do this problem. June 13th. Identify cum dividend cutoff and ex-dividend cutoff. Which of the following buyers will get dividend? So I will give you, means you can pause the video and try to do this on your own. So 1, 2, 3, let's discuss. So record date is 13th. 1 day prior is ex-dividend. So June 12th is ex-dividend, right? Because the settlement happens on 16th because it's a weekend, means all those things. You don't have to worry about it. 1 day before, it's a ex-dividend date, right? And everything before is cum, everything after is cum. Settlement doesn't happen on weekends. So if you buy some shares on Friday, the actual settlement will happen on Tuesday because Saturday, Sundays are not considered. So it will be Friday, Monday and Tuesday. So, but our logic, 1 day before ex-dividend. So June 13th is the record date. June 13th is a Tuesday. So Monday would be the ex-dividend date. Everything after ex-dividend will not receive dividend. Everything before ex-dividend will receive dividend. So these are all dates which are cum dividend. The shares are trading cum dividend, and whichever, and all these rates are ex-dividend. Try this one. The record date is Wednesday 17th. Identify cum dividend cutoff and ex-dividend cutoff and which of the buyers will get dividends. So pause the video, try it out, and 1, 2, 3. Cutoff date, record date 17th October. So X dividend date will be 16th. Every trade that happens after 16th or on 16th is X. So X, X, X. All these people are not going to get dividends. People who bought it before, that is 15th, 12th, etc., etc., all of them will get dividends. So those shares are come and others are X. Now, dividends can be regular dividends. The payment of dividend is maintained, bearing changes to company's financials and operations. So what happens is company generally keeps a stable dividend policy. It is stable either in percentage or it is stable in dollars. For example, Coke may have a stable policy of paying $1 dividend each year. So that's a regular dividend. So it has a stable policy. The dividend paid are according to the policy. But it's not compulsory. If Coke has bad years, it may not pay that dividend also, right? Extra dividend is something that is paid above the regular dividend that the company pays. So a bonus paid in addition to regular dividend does not imply that extra payment will be made regularly. Stock dividend is sometimes companies don't pay you dividend in cash, but they pay dividend in form of additional stock. So stock dividend in the form of additional stock rather than cash, typically paid by rapidly growing companies who don't have cash to spare, and treated as a regular dividend for tax purpose. So even though you're getting dividend in form of stock and not cash, so it is still treated as regular dividend for taxes. Next is dividend reinvestment plans. So certain company has this plan whereby instead of paying you dividend, the amount is reinvested by buying additional stocks. So there is a treasury department. So all the dividends that the company is supposed to pay are accumulated and they are paid to the treasury, and the treasury tries to buy additional stocks. So instead of getting cash dividends, you get additional stocks worth the dividend value. So dividends are used to purchase additional stocks in the company and not paid in cash. They are taxable as cash dividend. So dividend reinvestment plans, even though you're not getting anything, you're getting additional stocks, even then they are taxable. Now the difference between the previous thing, that is stock dividend and dividend reinvestment, is stock dividend results in creation of new shares. So companies creating new shares to give it to you. Dividend reinvestment plans means company buys it from the open market. So shareholders benefit by saving on commissions to purchase the underlying stock because they buy it in bulk rather than as an individual. So they pay lesser commissions, and you benefit from dollar cost averaging. Dollar cost averaging is when you steadily buy something. If you steadily buy mutual fund, or if you steadily buy a stock, or you steadily invest in a bond, the average price is harmonic mean, and it's not arithmetic mean. Harmonic mean is lower than arithmetic mean. So you save a few bucks because you get lower cost. Once again, dollar cost averaging. First thing to remember, it happens when you regularly invest. Second thing, it happens because the price that you get is a harmonic mean, and harmonic mean is lower than the arithmetic mean. That's the reason you get certain advantages. If you're attending my classroom, we are going to discuss this in much more detail. Otherwise, for the exam purpose, you have to remember two things. Dollar cost averaging means you get a better price, that is the average cost goes down. It happens when you regularly invest. Mathematical reason, because you receive price at harmonic mean rather than an arithmetic mean. Restricted shares which have a right to participate to an unlimited degree in in the earnings of the company and its assets on liquidation, but do not have full voting rights. So normal shares have voting rights that are proportional to holding. So one share, one voting right. But there are certain classes of shares called as class A, B, C, so on and so forth, which have different voting rights. So you may not get entire one voting right if you buy one share. So this is meaning of restricted. Restricted means the shares have the same right to participate in growth and participate in dividends, but they may not have the same rights as a normal shareholder in terms of voting. Restricted shares are of three types. Non-voting shares, so shares do not have voting rights at all, except in certain circumstances whereby the dividends are not paid and all those things. So unless and until specifically mentioned, these shares do not have any voting rights. Subordinate voting, share carry a right to vote by where there is another class of share outstanding that carries a greater voting right on per share basis. So what it means is normal shares have higher voting rights than them. So subordinate means normally you should get one share, one voting right, but subordinate share means maybe you have two shares and you get one voting right. So instead of having one share, one voting, they have created a subordinate category where two shares gives you one voting right. Restricted means normally these have same structure like a common share, but there is a restriction on how many votes you can put and how much percentage you can put. So shares which carry a right to vote subject to a limit or restriction on the number or percentage of shares that may be voted. So it may say that a person can own 20% shares, but an individual person can only vote 10%, at max 10%. So even if I own 20, 30 or 50, I can still vote only 10%. Now restricted shares are not so good for investors because investors don't have much control then if the shares are restricted. So there are certain regulations to protect such investors. So the regulations are these shares, the restricted shares, have to be identified by appropriate share terms. You cannot mislead an investor as a stock market participant by stating that those are common shares when they actually are a restricted shares. Restricted shareholders also have the right to receive all documents that normal shareholders receive, example annual statements, quarterly statements. They are identified in financial press by a specific code that is different from a common share. Dealers and advisors must identify the restricted shares. You cannot mislead an investor. You need to get notice of shareholders meetings and you have the permission to speak. You have the permission to question, but you don't have permission maybe if you are in a non-voting share to vote. And minority approval is required for creating restricted shares. Stock splits and consolidation. So stock splits means to reduce price of to a popular trading range. So what happens? Sometimes this company is doing really well. So the share price is moving up and up and up. So it may go out of range of a common investor. For example, if there are no stock splits. So when Microsoft started, it was a very small company, but over a period it started to grow and grow and grow. So if there was no stock split, the share price will also keep on increasing. So it may go to $1 million per share. Now, many small investors may not buy that share even though the company is good because of the price. So company has to make those shares affordable. So what they do, they divide those shares. So stock split is a way of dividing shares. So you create two shares from one. So you reduce the market price and you create more number of shares. Investors owning 100 shares with a current price of 40 and company allowances 2:1 stock split, that is 2 shares for every one old share. So what is happening? Instead of 100 shares, now you have 200 shares, but the price also goes down. Instead of 40, it goes to 20. So creating new shares from one, that is stock split. Does it impact investors' proportionate shareholding? No, because you have, let's say, 40,000 worth of shares, right? 100 into $40 is 40,000 before the stock split. Right after the stock splits, you have 200 shares, but the share price is 20 now. So it's again 40,000. So an investor is not impacted. But it is good for you because liquidity increases. People who are not buying looking at $40 may start buying that shares looking at $20. So it's good, liquidity improves when the stock split happens. Reverse stock splits, opposite to it. So instead of cutting down on market price, we increase the market price by combining two shares into one. So to raise the market price and improve a company's ability to refinance, it is sometimes done. 1:10 reverse stock splits when the share price is 40 means out of 10 shares, one new share is created. So if you are having 1,000 shares, so you will get one new share for every 10 old shares. So you, instead of 1,000, you now own 100 shares and the price is adjusted to $4. So price increases in reverse stock splits, price decreases in stock splits. Now, why it is done? Majorly, most of the exchanges have rules. So if the company's share prices is dropping, it may get delisted from the exchange, because share exchanges have stock exchanges have certain rules. For example, they will not trade any stock that is below $1. So in such case, companies do reverse stock split to increase the share price and enable investors to still trade on that exchange. Does it impact investors' proportionate ownership? No. This is a typical stock quote that you see. Now, the first three, four things that you see means this are related to 52 weeks. So 52-week high of this stock was 22.55. 52-week high low of this stock was 9.25. The stock is BEC, that is the name of the company. Dividend is 50 cents. The total dividend received in the last 52 weeks accumulates to 50 cents. Now everything else is daily. So it has a daily high of 10.65, a daily low of 10.25. It closed the day at 10.35 when the trading stopped, and previous to means compared to previous close, it closed 50 cents up, and the total volume was $6,000. So the first thing is 52-week high, the second is 52-week low, the company name, the dividend paid in last 52 weeks, daily high, daily low, the closing price, and the change that the stock received, and volume is 6,000 shares. Okay. Next is preferred shares. What is preference shares? So they are very similar to bonds. So instead of interest, you get dividends, but dividend is fixed. Please note, dividends are fixed. Okay. So dividend preferred shares are called preferred because preference dividends have to be paid before common shareholders get paid their dividends. So dividends must be paid before common shareholders, and in case of business failure, preferred shareholders are paid before the common shareholders. So whenever company sells all its assets, it will pay bondholders, debenture holders, then it will pay preferred shares, and then finally common shares. So they get preference over common shares. So important point, preference shares have fixed dividend. So why would company issue a share with fixed dividend instead of issuing a bond or instead of issuing a common share? If you issue a bond, you're contractually obligated to pay dividend, pay interest. So if you are not making enough profits, if your profits are zero, you have to sell your assets and pay interest. Otherwise, bondholders have the right to their assets, a right to your assets, right? Preference dividends are little different. If company is low on profits or it is having zero profit, it is not obligated to pay preference dividends also. So it can skip a few payments of preference dividends without selling assets. So it has better protection than bonds, right? And it has a downside too. So in preference dividends, generally you have to pay fixed dividends. In common shares, there is no fixed dividends. You may just deny to pay dividends, and that doesn't impact anything. But preference dividends, you are obligated to pay a fixed dividends unless and until there is enough profit, and you cannot pay anything to common shareholders before paying preference. So advantages over debt: there is no contractual obligation to pay dividends. There is no maturity date. So bonds mature. So when bonds mature, company has to pay the principal amount back. Most of the preference shares don't, means the simple preference shares doesn't have a maturity date, so it goes on forever. It gives greater flexibility for company because it doesn't increase the debt ratio. So you issue debt without changing your debt ratio, so that improves the flexibility of capital structure. Over common shares, preferred shareholders are only entitled to fixed return, that is, they are only entitled to fixed dividends. They do not participate in company's growth. So if the company grows from 100 millions to worth billions tomorrow, preferred shareholders are only going to get fixed dividends. They do not have ownership of any profits or any asset exceeding their par value. So you don't have to pay anything else other than fixed dividends. So why preferred are considered as investments? Because the cash flows, there are tax advantages to dividends. There is no tax advantage to interest. So if I give you an option of buying a bond versus buying a preference shares, if you buy a bond, you get fixed interest. If you buy a preference shares, you generally get fixed dividend unless and until the company is in profit and it is paying, right? But interest has no tax deductions, so you have to pay everything in terms of taxes on it. Dividends have little better tax deductions for an individual also and for a company also. For an individual, you get certain dividend tax credit. For a company, if you're a Canadian firm receiving dividends from a Canadian company, the dividends are tax free in your account. So for an individual, buying preferences makes sense because you get certain dividend tax credits. For a company, it makes sense to buy preference shares because all the dividends that are paid to you are tax free. Preference in dividends and assets on wind ups. So if the company closes down, you are paid before the common shares. Dangers: there is purchasing power risk. So if inflation goes up, your dividend may not have much value. Preference shares are exactly like bond. They are impacted by interest rates. So if interest rate goes up, the price of preference share, the value of preference share goes down. And if interest rate goes down, the value of preference share goes up. So that is a risk. Dividends could be passed over, so it's not compulsory to, or it's not obligation to pay dividends. If company is not profitable, it may not pay dividend, and the company could fail, so you could lose getting future dividends. Why company issues preference shares? So maybe it has lot of debt, so it cannot issue any bonds. The existing assets are heavily mortgaged. Market conditions may not be suitable for debt or equity issue. Debt to equity ratio is very high, so it doesn't want to impact that ratio. It has reluctance to assume legal obligations to pay interest and principal. So it decides it is very difficult to pay interest and principal right now, so better issue dividend paying because it's not as strict obligation as bonds. Paying preference dividends is not expensive, so it considers that it may be cheaper to issue preference shares than issue bonds. Okay, we have discussed this, sorry. Preference share features: so there is a par value. Dividends are stated as a percentage of par value, or they are stated in dollar terms. So certain preference shares will have, let's say, $50 par value and dividend rate is 10%. So you get $5. 10% of $50, that is $5 as dividend each year. Or they may have, they straight away tell you how much dividend they pay. For example, par value $100 and pays a dividend of, let's say, $6. So they straight away tell you. There is generally no maturity date in a straight preference share. Voting rights, there is no voting rights unless and until dividends are paid on schedule. If dividends are skipped for many periods, then preference shareholders may be given, generally are given voting rights. So what does company do? If the company is able to pay dividends regularly, preference shareholders don't get any voting right. But if company skips a few dividends to encourage preference shareholders, they may issue voting rights, and it is generally issued. Cumulative and non-cumulative. So types of preference shares now. Cumulative means if a dividend is not paid in a particular year, you have the right to previous dividends in future. So unpaid dividends accumulate in arrears and they are paid. Preferred dividend arrear must be paid before common shareholders are paid. So if I don't get paid dividends this year, company has to pay this year's dividends in future from future profits. So they accumulate. Non-cumulative, they don't accumulate. So if a dividend is kept this year, it's never paid. Straight preference shares, normal, no term, no maturity term. They are generally non-cumulative, they are non-participating, etc., etc. Other types, convertible. So you have the right to convert to common shares at a specified time and a price. So they are exactly like convertible bonds or debentures. So you may convert them to stock, right? And stop getting fixed dividend and participate in stock market growth. Now conversion can be, you can decide to convert, or there can be forced conversion clauses. So it can be both ways. So you have the right to decide, or sometimes the company can force you to convert. So be careful while buying. Second point is, it's a very good thing, because if the company is not doing as you expect it to do, you keep on getting fixed dividends, so you are good. But if company starts to perform really well, you can just convert them to common shares and participate in the company's growth. Retractable creates a maturity date. So means in retractable shares, the issuers, the buyers, that is the investors, have the right to ask company to pay them back the purchase, means the par value. So investors can force the company to buy back at a specified time and the price. Floating rate or variable rate. So in these kinds of preferreds, so interest rates keeps on fluctuating, so dividend rates also keeps on fluctuating based on the interest rates. Convertible preferences, the advantages is potential capital gain on common stocks, security of a preferred, so fixed dividends until you convert, higher yield than common shares. So in dividends are better in preferred shares versus the common shares. No commissions on conversion, so you don't have to pay any commissions because it's internal, you're not buying from an external source. Disadvantage, lower yield than preferred, means straight preferred. So example is a $25 preferred share pays $2.5 in dividend and can be converted into 2 shares. So $12.50 is the price. Interest rate in the market for similar risk securities have a yield of 9%. The share price commonly trades at $35 a share, but the preferred share is trading at 30. So what it means is, generally convertible securities are issued at premium. So if you see, normal share is traded at $15. So if you buy 2 shares, you have to pay $30. Now you can convert this preference shares into $2 into 2 shares, but you're buying it at 32 instead of 30. So your price of conversion is 32 divided by 2, that is $15.5 instead of 15. This additional $0.5 that you pay, that or 50 cents that you pay, is your premium. So convertibles are majorly issued at premium. So if a common stock is trading at, let's say, $100, a preferred stock that can be converted into one stock will not trade at $100. It will be issued at, let's say, 105 or 106. So there is always a premium. This premium is expressed either as dollar or it is expressed as percentage. Generally, it is expressed as percentage to make it more comparable. Preferred features, that is retractable, so there is a retraction date mentioned. It is desirable as market rates rise, can reinvest proceeds at a higher rate. So retractable means you can ask the company to buy back those shares from you. So it is desirable if interest rates are rising, you can ask them to buy back and invest at a higher rate. Price is less volatile as the retraction date approaches. Capital gain if purchased at a lower price and tendered at retraction. So buy at 90, then at the first retraction date sell it at 100, and the price is there. Advantage, preferred features. Okay, the next type is floating shares, that is the interest rate goes up and down, the dividend goes up and down. Advantages, protection against interest rates increases, price is less volatile. Disadvantage, dividends will fall if the interest rate falls. Now there are certain preferred shares that are foreign pay, that is, it pays dividends in some other currency. So example, a Canadian firm issues a preferred share that pays dividends in American dollars. So it's a foreign pay preferred share. Advantage for you is you get exposure to American dollars. So advantage, foreign exchange gains if Canadian dollars falls. So if Canadian dollars is falling and you receive American dollars, then you can convert that dividend into Canadian dollars at higher money. So actually your dividend is rising. And foreign exchange risk if Canadian dollar rises in value. So you are getting American dollars, so you may not be better off when the Canadian dollar rises. Other types of preferred, participating preferred and deferred preferred. Participating means they have right to additional dividends after a fixed dividend. So if company is growing and paying higher dividends, apart from the fixed dividend, you also get right to those additional dividends. And deferred prefer means they don't pay any dividends, but the gain that you make is difference between the price that you buy at and price that you sell at. So you get capital gains. Important point is those capital gains are treated as dividend payments, are not treated as dividend payments, they're treated as capital gains. So there is no tax advantage. So deferred shares pay no dividend until a future maturity date. Dividends are compounded without having to pay annual taxes. Dividend premium is not eligible for dividend tax credit. So whatever capital gain that you make, it is not considered as dividend, it is considered as capital gains. At maturity, the accrued dividends are treated as interest income. Next is stock indexes and averages. So there are two ways. What is a stock index? Stock index means it's accumulation of stocks. It is a barometer for economy. It tells you how the economy is doing. It is also used for creating index funds. It is also used in derivatives. So this is the benefit of stock index. It's a barometer. I mean, it tells you how the economy, how the stock market is performing. What is a stock index or an average? It's accumulation of stock. For example, Dow Jones Industrial Average, it's accumulation of 30 stocks that are traded on NYSE. So by looking at one figure, you can kind of guess how those companies are doing, right? Say same way S&P 500, it's accumulation of 500 stocks on NYSE. It tells you how the overall market is doing, right? Now there are two ways to create stock indexes. One is there are two ways to create such an thing. One is taking market cap, or it is also called a stock index, or second is taking the price, only price, not the market cap. That is called as stock average. So average and index. Index is generally market cap. Now what is market cap? Market cap is number of shares multiplied by the share price. So it is nothing but size of the firm. So market cap is considering each firm according to its size. So Apple is a 600 billion dollars worth company, so that is its market cap. Then Microsoft, it's 300 billion dollars worth, so that is the market cap. So that is how you consider it. The disadvantage of constructing an index according to market cap is the larger company has all the say. So if Apple moves up and down, so it is very large. It's $1 trillion, means let's say it's a trillions of dollars worth of company. So that will influence the index also. So maybe all other companies are not doing great. Only Apple is moving the index because it is so big. Now second is stock average. Stock average, you don't consider market cap, you don't consider size, you just consider price. So what is the price of each stock, right? You do an average of it. Disadvantage is stocks that have higher price will influence the average. So if a stock is worth $2,000 and all other stocks are in the 20s and $30 ranges, then this $2,000 will have all the say. It will move the index. Okay. Now you have to remember, stocks averages needs to be adjusted for stock splits. So generally stock splits adjust whenever stock split happens, the denominator is adjusted upwards, and whenever consolidation reverse stock split happens, the denominator is adjusted downwards. Canadian market indexes, so we have SAP TSX Composite, SAP TSX 60 and SAP TSX Venture. So this is an venture index, this is for top 60 companies, this is a composite index. So we have Canadian indexes also. Most of them are market cap based. Then US indexes are there, for example Dow Jones, S&P 500, Amex, NYSE, Nasdaq, value chain, etc. And there are international market indexes and averages, for example FTSE, which is an UK based index. Then there is DAX, which is a German index. Then there is Nikkei, that is the Tokyo based or Japan based index. Nikkei is price based. Most of the other indexes are market cap based. So that's it in this chapter. I will encourage you to read this part from the book because it's very information centric. So you just have to give it a quick read. Nothing much to discuss here. So that's it. We'll catch up in next recording. Facebook that we have just discussed. So we are looking at Facebook Inc. So price of Facebook is, let's say, $140. I'm ignoring the decimal places. So price of stock Facebook is $140. So let's see what happens to Facebook if you do let us first compare cash buy and margin buy, and then see what happens if you short sell it. So cash buy, if you're buying one stock of Facebook, you have to pay, let's say, $140. So you bought one stock of Facebook. Second, if the stock goes to $150, you make profit. Profit will be 150 divided by 140, final price divided by initial price minus 1. So profit percentage would be 7%. If stock goes to 130, you lose money. So 130 divided by 140 minus 1, you lose 7%. Now if you do a margin buy, not margin sell, margin buy or a margin you take a long position in margin. First of all, you don't need $140 to buy Facebook. 50% would be, let's say, loan to you, and 50% of the amount you have to put in. So let's say you put in $70. Okay, stock goes to 150, you make profit. How much is profit? You put in $70, $70 was loaned to you, so you bought the stock at $140 and the stock is currently traded at 150, so you have made a profit. Profit is 150 minus 140 divided by investments. Now you have not put in $140, you have put in $70. So you are getting a return of 14%. Same way, if stock goes to 130, you would lose 130 minus 140 divided by 70, that is 14%. So what happens when you do a margin buy? You have leverage. Since you are not investing entire amount, you're putting a part of it and taking a loan. Returns, profits as well as loss is more. So this is cash buy and margin buy. Now, if you do a margin sell, how does it work? First, you borrow the stock. Okay, so let's say the price of stock is 140. Generally you have to put in more money than the borrowing money. So how does it work? First of all, the broker will give you percentage of capital you need to have to short sell the stock. Let's say the percentage of capital is 150%. So you need to have 140 multiplied by 1.5 in your account. So you need to have $210 in your account. So you invest $210, borrow the stock, sell the stock. So when you sell the stock, you get money from the market. So you get $140 by selling the stock. So how much is actually there in your account? So your deposit is $70. So what did you do? You put in 210, 150% of market value. You got the stock, you sold it in the market, you got back 140. So effectively you are just putting in $70 in your account to borrow the stock and sell it. Now if stock goes to 130, what is happening? You have already sold it at 140. What you can do now, buy it back at 130 and give the stock back to the broker. So what is your gain? Your gain is $10. Okay, on how much you have invested? $10 over 70, that is 14%. If the stock goes to 150, you have a commitment now. You have to give the stock back to the broker. So you would face a loss. How much is the loss? Negative $10. You got in $140. Now you have to pay $150 to buy that stock back. So loss is negative 10 over deposit of 70. So you're losing 14%. So this is how short selling works. If the stock goes down, you make money. If stock goes up, you lose money. Okay, so let's go back to slides. So there are 4 types of trade: cash buy, cash sell, margin buy or long, or margin sell and short. So speculative trading practices are buying on margin, that is a long trade, and selling on margin, that is a short trade. You buy on margin when you predict that stock prices are going to go up.
You sell on margin when you're predicting prices are going to go down. Advantage is that you need less money to trade. Disadvantage is the profit and loss can be big. So this is an example they have given. I just shift this here. So an investor believes that stock will increase from 25 to 30. Investor has 2,500 to invest. So if you trade in cash, your stock is going to, you're buying 10 stocks, sorry, you're buying 100 stocks at 25. So you're putting $2,500. The stock is now 3,000 worth. So 3,000 minus 2,500 divided by 2,500, you're making 20%. If you trade in margin, by putting in $2,500, you can buy stocks worth $5,000, which then become $6,000 worth. So 6,000 minus 5,000 divided by 2,500, you make 40% return. So same analogy, if you trade in margin, profit and loss is more. Now for margin trading, you generally have to put these amount of money. So sometimes the exchanges will say that securities are eligible for reduced margin. In that case, you have to put 70% of market value. That is 70% of market value will be loaned to you. You have to just put in 30%. Mostly $2 and above shares have 50% loan. So 50% you have to put, 50% would be extended to you as loan. Facebook, for example, is 140. So it is more than $2. So you have to put in 50. The broker will lend you 50 unless and until it is eligible for reduced margin. 1.75 to 1.99, if the share value is that, 40% will be loan, 60% you have to put. 1.5 to 1.74, 20% would be loan, and rest 80% you have to put. Under $1.50, no loan would be extended to you. Trading margin long, the risk are margin increases the market risk, so profit is more as well as loss is more. Loan and interest must be paid, so you have to pay interest on the loan that you are taking. Margin call must be paid without delay, so if there is loss and the margin account goes down, you have to replenish it, otherwise the position is closed. Sometimes you are forced to sell out. So broker wants his money back and he says close the position, so you're forced to sell out. Next is short selling. Short selling means you're borrowing stock. Generally you have to put in more money. So if securities are eligible for reduced margin, you have to put in 130% of the market value. If it is $2 and above, generally 150%. If it is $1.50 to $1.99, you have to put in $3 per share. 0.25 to 1.49, 200%, and under to 0.25, 100% of market plus 0.25 per share. Risk in short selling, time limit on short sell, there is no time limit as such, but broker may want his share back, so you may be forced to sell out. Covering short positions, generally when markets are going down, lot of short sellers will try to cover their positions and take in profits. Because of this covering, the stock price generally rises, so there can be spikes in stock price that may lead to loss for you. You have to declare a short sell, so whenever you are short selling, you have to declare it to the exchange. Risk of short selling, you are borrowing shares which has to be returned no matter what is the price. You have to always keep in adequate margin. If margin decreases, you have to replenish money or close the position. You have additional liabilities. For example, you have to pay dividends that are paid on the share. You have to compensate the person who is letting you borrow shares with dividends. There are buy-in requirements. Sometimes you have to buy back those shares and give it back. There is insufficient information about margin sellers may not be readily available. Price actions can be erratic and can lead to losses. There is unlimited risk, so when stock price goes up, you lose money. Hypothetically, stock price can go to infinity, like in Infinity Wars. Some lame Marvel joke. Regulatory risk. Sometimes the regulator ban margin trading totally. For example, when banks were falling in 2008, short selling was banned on banking stocks. So when the short selling is banned, you have to cover your positions. So that's a risk. This is a typical retail transaction in securities. How does buying and selling work? So you buy through an investment advisor or a dealer, or through brokers. You either trade on stock exchange or you trade over the counter, that is through on a dealer terminal. And seller also has a investment advisor or a dealer that represents him. So these two guys trade and you trade through them. So whenever you're buying a stock or selling a stock, you have go through a dealer or a broker. Dealer and a broker have an option: either they trade on exchanges, or they trade through dealer terminals like Nasdaq's. What different types of order you can put? So whenever you are executing a trade, these are different types of order you can put. A market order is where you don't specify a price. For example, if I put in a market order to buy, whatever is the best possible price for buying, I'll get that. If I put a market order to sell, whatever best possible price is there for selling, I'll get that. So buying at market or selling at market means you don't mention a price, you just take price from the market. Limit order, you mention a specific price. So let's say Facebook stock is $143. I want to buy that stock at 135. Then I'll put in a limit order of 135. If the stock reaches to that price or goes below it, then the stock means I will be able to buy the stock. Otherwise, the order will remain unexecuted. Same way, if I want to sell my Facebook stock at 150, I can put a limit order of 150. If stock price reaches 150 or it goes above, my order will be executed. So limit buy executes when prices are at or below. A limit sell executes when prices are at or above. Okay. Good through order or GTC, good till cancel orders or good through orders. So generally orders are only valid for a day. For example, day orders are valid for 1 day. But if you want to extend your trading, let's say I want to buy Facebook stock at $120 and I don't know when Facebook will reach 120. So I'll put a good till cancel order for a month. So unless and until I cancel it, the order would be there in the system of 120. If stock reaches that, it will be execute. Otherwise, the order will remain in the system but unfulfilled. Next is stop loss or stop buy. Now this you have to remember. If you do a long trade, the risk that you have is stock going down. So I'll explain it on Excel. As thinking to do it in a very shortcut kind of a way, but it's an important concept. It's better you understand it. So you're doing a margin buy or a long trade. So what are you doing? You're buying stocks. So let's say you bought Facebook at 140. If the stock goes up from here, there is no issue, you're making profit. If the stock goes down, you make a loss. So let's say if it goes to 130, you're already making a loss of $10, right? Now let's say I only want to take $10 of loss. Okay, so I have bought this stock. So counter trade will be, to close this trade I have to sell the stock. But if I put a limit sell order, if I do a limit sell of 130, the issue is it will be executed right away even if the price is 140, because limit sell works. Limit sell sells the stock if price is at or above. So if I put an order of 130 and the stock is currently at 140, with limit sell it will execute right away. So I have to put a different order. That order is called as a stop loss order. Stop loss order means the stock will only be executed, this order will only be executed at or below. So if the price goes to 130 or it goes below 130, order will be executed. So when you do a margin buy or when you trade long on stocks, you can put a stop loss order either to protect your gains or to protect you from losses. Okay, you can put a stop loss order to protect your gains or to protect you from losses. Same way, if you do a margin sell or a short sell order, so if I short sold Facebook at 140, if the stock goes down I make profit, if the stock goes up I make loss. So if stock goes to 150, I'm already in loss of $10. If this is the maximum loss I can take, I cannot put a limit buy because limit buy executes at or below. I don't want that. I want my order to be executed when it goes to 150 or little above it. So I'll put a stop buy order to protect my loss. Stop buy executes at or above. So thing that you have to remember, if you do a margin sell or if you're doing a short sell order, you put a stop buy order to protect your, not stop but stop buy order, a funny typo, to protect your gains or protect you from loss. So in exam you have to remember these things. If you do a margin buy or if you do a long trade, you put a stop loss order to protect your gain or protect you from loss. If you do a margin sell or short sell, you put a stop buy order to protect your gain or to protect you from loss. Then there is pro or NC order. Pro or NC order means if three individuals are trading, if dealers are trading, brokers are trading, or if insiders are trading in the company, they have to designate their orders as pro orders, professional orders, because there is a priority of transaction. All client orders are executed below professional orders. So if a broker is trading along with the client order will have precedence over the broker's order. So all brokers, dealers and insiders in the company have to designate their trades as professionals. So market order, an order to buy or sell a specific number of securities at prevailing market price. You don't mention any price, whatever prevailing price is there, you buy and sell at that. Limit order, you specify a price, it executes at the specific price or better. Day order, an order to buy a security that is valid only for the day it is given. All orders are considered day order unless and until otherwise stated. Good till cancel order, an order that remains outstanding until it is executed or cancelled. Stop loss, an order to sell that becomes effective when the price of one standard trading unit declines to or fall below a specific price. Generally it becomes a market order when stop loss price is reached. Protect your gains as well as protect your losses or protect you from losses, generally given when there is a long position, when you have bought the stock. Stop buy order, an order to protect short sell. It instructs the broker to purchase the share when it reaches a specific price. Pro or NC order from non-clients, partners, directors, investment advisors, etc. are stamped professional orders. Non-client orders or employee orders to deal with preferential trading rule. What is preferential trading rule? A trading regulation that means that clients orders will always have priority over members order if both orders compete for the same price for the same security. So client first. So that's it in this recording. We'll catch up in the next recording. and this is an important recording, so I would urge you to see it once again, specifically the initial part where we discussed the 4 types of trade that we did. Thank you and have a nice time. Hello friends. So in this recording we are going to discuss derivatives, and I'm giving you a heads up. It's going to be a long recording. So what are the chapter highlights? So when investing in common shares of the company, the value of that holding is generally based on number of shares owned multiplied by the current price. As the market price rises or falls, the value of investor holding also rises or falls. Derivatives are little different from holding shares or holding bonds. The value of derivative is tied to something else, an underlying, such as a financial asset or a commodity. It is the performance of this underlying assets that determines value. So what am I going to do is I'm going to discuss this definition. I'll explain you what is a derivative, what are the different types of derivatives. Then we'll come back to these slides and then go forward. So derivative is a financial contract that has its value derived or dependent upon the value of some other asset. The underlying asset of the derivative can be a financial asset such as a stock or a bond, a currency, or even an interest rate or equity index. So derivatives you can have on financial products as well as on commodities. It can also be a real asset or commodity such as crude oil, gold, or wheat. So I'm opening an Excel. First, let us understand what derivatives are and then come back and discuss those slides. So we are going to discuss 3 kinds of derivatives in this Excel sheet. So the concept of derivatives, then forwards, futures, and options. There are few more things like warrants and rights that we'll discuss along with the slides. Okay. So first is, what is derivative? So I'll give you a simple example for it. Let's say you are currently based in Calgary, but you moved to Toronto and you are looking for a place to rent. So what has happened? You got a job in Toronto. You have 2 months to be there. So you have currently 2 months. But you visit your friend in Toronto over the weekend, and while visiting, you look for few places in Toronto to rent out. And you really like this place. So there is this place A, let's say, and Mr. Smith is the owner, and he's offering that place after 2 months. So currently it is rented out, but after 2 months it would be vacant, which exactly suits your timeline. And after 2 months he's offering this place to rent at $1,500. So this is the transaction. So Mr. Smith says that I have a place, after 2 months I can rent it to you, but I will charge $1,500 for that as rent. So you are considering whether you should take it or not. The current rent that you find out in the market for similar properties is right now $1,500. So the current rent is also $1,500. He is asking for you basically $1,500 also, right? Now what is risk for you if you don't rent this place? What is the risk that you are facing? The risk that you are facing is 2 months down the line, the property market in Toronto goes up and the rents go up. So you may not get any place at the current rate, that is $1,500. So if you don't rent out this place right now, in future prices may go up. So the risk that you face as a buyer that is as a renter in this case, is the price may go up and you would have to pay more rent. Mr. Smith, for Mr. Smith, the risk is that rent may go down. Currently he is able to rent at $1,500, but rent in the market may go down and he may have to rent it at a lower price. So as a seller, he has the risk of price going down. He may get 1,500 right now for something, but in future the price may go down than 1,500. So how do both of you mitigate your risk? So buyer has a risk of price going up. You can buy right now at a specific price, but in future the price may go up. Seller has a risk of price going down. Right now you can buy certain thing at a particular price, but price may go down in future. So how do you mitigate this risk? Both of you, Mr. Smith and you. So you get into a contract. What is this contract? Contract is to rent the place after 2 months at a predetermined rate, 1,500. So buyers and sellers are agreeing to transact in future, but at a predetermined rate. Okay. So buyer is agreeing to buy in future at a predetermined rate. Seller is agreeing to sell in future at a predetermined rate. So this contract is nothing but a derivative. This contract is nothing but a derivative. So you as a buyer are agreeing to rent the place or buy the place at 1,500, and Mr. Smith as a seller is agreeing to rent this place or sell this place at 1,500 in future. Now situation 1, rent of properties after 2 months shoots up to 1,700. So similar properties in Toronto are going for 1,700 per month in rent. So who is benefiting because of the contract you have made? So buyer is benefiting because everyone else is renting the place at 1,700. The buyer, because of this contract, can rent the place at 1,500. So you're renting lower than the market or you're buying lower than the market, so you benefit. So you make a profit. Same way, if the rent were going to be $1,400 instead of 1,700 after 2 months, what would happen? Seller would benefit. Everyone else is giving their place at 1,400, but because of this contract, the seller is able to give this place to you at 1,500. So he's getting $100 extra. So seller benefits. Okay. So the concept of derivative is a contract to buy and sell an asset in future at a specified price. Buyer agrees to buy at a specified price in a future date. Seller agrees to sell at a specified price in future date. If price goes up, buyer benefits because he can buy lower than the market. If price goes down, the seller benefits because of this contract he can sell higher than the market. Okay, so each party having opposite risk are mitigating it. Now let us take something real. So let's say you are a country like China who is a major importer of crude. So you import crude in large quantities, and there is a country like Canada, which is an exporter of crude. So we export crude. The current crude price in the market, let's say, is somewhere around $70. Okay, the current crude price is $70. So what is the risk that China faces because it buys crude? And what is the risk that Canada faces because it sells crude? So risk that they face is China is currently able to buy crude at $70. In future, the crude prices may go up and it would have to pay more to buy the crude. Canada has an opposite risk. Canada is able to sell crude at $70 right now, but if crude prices start going down, it will have to sell crude at a lower price. So what they can do, they can create a contract, a forward contract, in which China agrees to buy crude from Canada in future at $70 and Canada agrees to sell crude to China in future at $70. So they get into a contract at a predetermined price. Now, if crude goes to $80, what would happen? Everyone else is trading crude at 80, but China, because it has a contract with Canada, can buy crude at 70. So China becomes in profit. So buyer of forward gets profit if price goes up. If same way, Canada loses money. So seller, just a second, seller makes a loss if price goes up. So if price goes up, China makes profit because it can buy at a lower price. Canada makes a loss because it has to sell at a lower price than the market price. If price goes down, let's say to $60, Canada makes a profit now because everyone else, every other country is selling crude at 60. Canada can sell its crude at 70 due to this contract with China. So seller is in profit and buyer is in loss. So these are forward contracts. Forward contracts are customized contracts between two parties. So this contract is very unique to China and Canada. If China wants to do a contract with United States, it has to do a separate contract. It cannot transfer this contract. Okay. So this contract is extremely unique. So it is customized. It is non-standard. It is traded between two parties, right? Mostly forwards are traded over the counter. So there is an investment bank who breaks the deal between two parties. So they are traded majorly over the counter. There is no exchange trading. And they have a large counterparty risk. So any country can default on its commitment. So if crude goes to 80, Canada may deny to sell to China at 70. So China faces a counterparty risk. Same way, if crude goes to 60, China may deny buying crude from Canada. So if crude goes to 80, Canada will stop selling to China, may stop selling to China. So China has a counterparty risk. Same way, if crude goes to 60, China may stop buying from Canada. So Canada has a counterparty risk. And there is generally no way to mitigate this counterparty risk except legal measures. Okay. So this is an example of forwards. Things to remember: forwards are type of derivative. The price of forward depends on price of underlying. So underlying was crude price here. If crude price was going up, buyer was benefiting. If crude price is going down, seller is benefiting. So derivative is a contract that of which price is based on the underlying was crude here. Then both buyers and sellers had right and obligation to buy and sell. Okay, so China has to buy, and China also can make Canada to sell. Same way Canada has to buy, has to sell, as well as it can make China to buy. Okay, so both parties have rights and obligations. Few unique things to forwards: they're customized, they're traded over the counter, they're not traded on exchange, they are non-standard, and they have counterparty risk. Now let's go to forward. So let's go to futures. So let's say there is Facebook stock that is traded at $140. Okay, the current price of Facebook is $140. Now you think that Facebook will go up, so you want to buy at the current price, hoping that Facebook will go up in the future. So that is your view. So buyer thinks Facebook is going to go up. Same way, there is a seller who wants to sell Facebook right now because it thinks that Facebook is going to fall in future. So he wants to get more money right now. So there are two parties, buyers and sellers, who have opposite views of Facebook. So buyer will get into a derivative contract. So he gets right and obligation to buy Facebook in future at $140. Okay, seller gets into a contract again, and he has right and obligation to sell Facebook at $140 in future. Okay, so buyer is getting into a contract to buy Facebook in future at a predetermined price. Seller is getting into a contract to sell Facebook in future at a predetermined price, right? Now imagine Facebook going to $160. What would happen? Who will benefit, buyer or seller? So in future, let's say after 1 month, Facebook is trading at $160. So who will benefit? Buyer will benefit. Why? Everyone else is buying Facebook at $160. Buyer can buy this Facebook stock due to this contract at $140. So he's buying lower than the market. So he's benefiting. So if Facebook goes to $160, buyer makes money, so there is profit to buyer. And if Facebook goes to $160, seller loses money, so there is a loss to seller. So if stock goes up, buyer makes profit, seller makes a loss. If stock goes down to $120, what would happen? Seller will make money now. Everyone is selling stock of Facebook at $120. Seller can sell stock at $140. So you are selling higher than the market price. So you will be in profit. So there is profit for seller and there is a loss to buyer. So if price goes up, buyer makes profit, seller makes loss. If price goes down, buyer makes loss, seller makes profit. So this is exactly same as forward. So what is the difference now? Difference is these contracts, these future contracts are traded on exchange. So that's the first difference. Second difference is they are standardized. So generally they are traded in 100 units. So you buy and sell units in the multiples of 100 Facebook stocks. Okay, next, since they are traded on exchange, there is clearing and settlement. That is, exchange and the clearing agents take the counterparty risk. So if you are making profit as a buyer and seller is unable to pay you, then exchange will pay or the clearing agents will pay. Same way, if you are making a loss and you are not able to pay, then the counterparty will get his share from exchange and then the exchange will sue you. So ultimately you have to pay, but the thing is there is no counterparty risk because exchange or the middlemen, the clearing and settlement agents, they stand in between. Okay, so they take on the counterparty risk, so they are much safer. Okay, so difference between forwards, these are exchange forwards and futures. Futures are exchange traded, they are standardized, there is no clearing and settlement risk. There are a few other differences that we will discuss when we go through the slides. Now, what is issue with forwards and futures? The issue is you can make a lot of profit if the trade goes your way, but you can make a lot of loss if the trade doesn't go your way. So if Facebook stocks keeps on going up, buyer will keep on making profit, but if it starts falling, you will start making losses. And like we discussed in margin trades, futures will also generally require an initial deposit. So you don't have to put in the entire amount, you just have to deposit a small amount to make a big trade. So there is concept of initial margin like we discussed in margin trades in the previous module. So initial margin means you don't have to deposit the entire amount, you only deposit a part of it and you trade on a bigger chunk. So let's say Facebook is at 140 and if you are trading in one lot that is of 100, so 140 into 100, so you're trading stocks worth 14,000, but generally you would have to deposit, let's say 5% of it, that's it. So you can trade by putting in just $700 stocks that are worth 14,000. So profit and loss are magnified and they can be big. So you can lose all your money plus extra money, and you can make a lot of money also when you trade in futures. And this double-edged sword happens because there is rights as well as obligations. So as a buyer, you have right and obligation to buy whatever is the price. You have right when the stock price goes up and you're making profit, but you have an obligation when the stock price falls and you're making loss. Same way, seller also has right and obligation to sell. So it's a double-edged sword. You can make a lot, you can lose a lot. So how do we counter this shortcoming? So this shortcoming is countered through the use of options. Now there are two types of options, call option and put option. I'm going to discuss call option first. Now option means buyer just has the right, there is no obligation on him. So if he is in profit, he will execute the trade. If he is not in profit, he will not execute the trade. Before I forget, futures are traded up to 9 months. So whenever you are trading on exchange, you can trade up to 9 months in future. So you can buy and sell some stock, or you can even buy and sell some index 9 months in future. Now let's say we are discussing options. So options gives you only right, but there is no obligation, okay, as a buyer. So we are discussing first call option. Now there are two parties. There is a call option buyer and there is a call option writer. Call option buyer has right to buy but no obligation. Call option writer has obligation to sell but only when buyer executes. Now these are fancy words. I'll explain it to you. So let's take an example. Let's continue the example of Facebook. So Facebook stock call option is trading like this. So the price of execution is $140. It's a 3-month call. So within 3 months you can execute it, and you can, if it is an American option, you can execute it any day. Most of the options that are traded on traded in North America are on stocks are basically American options. On indexes they may be European, but for time being just consider that you can execute any day. Okay, so within 3 months you can execute any day at $140, and it's a call option, so you can buy any day at 140, and this option is trading at $10. So $10, it's the premium. So what does it mean? So as a buyer you click on buy. As a buyer of call option you click on buy. So what do? You pay $10 as premium to writer. Premium once paid is never returned. So premium is a cash outflow that you will never get back. So you pay $10 to writer to buy this option. After paying premium, what do you get? You get right to buy Facebook stock at $140 any time in 3 months, but there is no obligation on you. Okay, no one can force you to buy it. If you want, you can, otherwise you can just let it go. So after paying premium you get this. Now imagine if Facebook starts trading at $180. What would happen? Everyone else in the market is buying Facebook at 180. Because of this contract that you bought, you have a right to buy Facebook at 140. Would you buy? Everyone else is buying at 180. You have the right to buy it at 140. Of course you will buy because you're getting a better price than market. So you execute. So what is your profit? The thing that was trading at 180, you are buying at 140, but you paid a $10 premium. So your profit is $30. So by paying $10, you got $30 back if stock goes to 180. Now, if stock falls to $100, what would happen? If it was future, you would suffer a loss because you had an obligation to buy at 140 when the stock was trading at 100. But this is not future, this is option. Do you have any obligation? There is no obligation. So you decide not to execute this contract. So what is your loss? Your loss is $10 that you paid. So just think back. You can rewind the video and see it. You can go back and play again. Okay, so loss is only the premium paid, but profits can be big. So what is a call option? Call option means you profit, you make money when price goes up, or you make profit when price goes up above your execution price. Okay, and you lose money when price stays same because premium paid is not returned to you, and you will not execute if price is 140. There is no advantage in executing, or if price falls. So you lose money when, so there is a loss if price remains same or price falls, but the fun part is loss is limited to premium paid. This is call option. Call option gives you right to buy an underlying at a specified price, but there is no obligation. It makes money when price goes up. It loses money if price goes down or it remains same. Maximum loss is always the premium paid. You cannot lose beyond that. So call option is a mechanism of getting small losses and betting on big profits. Okay. Next is put option. What is put option? It is right to sell but no obligation. It is right to sell a stock but there is no obligation at a specific price within a future duration. So let's say same thing with Facebook. $140 is the Facebook price. You have a 3 months put trading at $10 and you decide to buy this put option. So when you decide to buy, you pay $10 as premium. Premium once paid is never returned back to you, so it's a cash outflow. You'll never get it back. But because you have paid this premium, you get right to sell but no obligation at $140. So anytime in future you can sell Facebook at $140. Now if Facebook goes to $100, everyone else in the market is selling Facebook at $100. Because of this contract, you have a right to sell Facebook at $140. So something that is at 100, you can sell at 140. So you are making profit. So you are selling at 140 where everyone is selling at 100. But to buy this, you paid $10. So you make a profit of $30. If Facebook goes to $200, if you were seller in future, you would make a loss because you had an obligation to sell at 140 when the price was 200. But this is not future, it is options. So you have right, but there is no obligation. No one can force you. So you may decide just not to execute. You will not buy stock that is worth, you will not sell stock that is worth 200 for 140. So you give up your premium. So $10 is your loss. So what is put option? Put option is right to buy, right to sell at a predetermined price but no obligation. So when price goes down, you make profit. When price goes up, you make loss, but loss is limited to premium paid. Okay, so these are options. Now let's get back to slides and discuss it. Okay, so types of derivatives are forward, futures, options, rights and warrants. Rights and warrants we are going to discuss along with the slides. So what are forwards? Forwards are contract between buyer and seller. Both parties have obligation, so both parties obligate themselves to trade the underlying asset in future at a price agreed upon today. Neither party has given other any right, so you have both rights as well as obligation. They are both obligated to participate in future trade. A forward contract in which is a one in which obligates one party to buy and another one to sell a defined amount of underlying asset at an agreed upon price at a specified time in future. The buyer does not pay the agreed upon price right away, nor the seller pays anything. That is, seller doesn't deliver right away. They both do it in future. Payment and delivery takes place at a specified time in future known as the delivery date. The delivery price is agreed upon when the contract is entered. So what are you doing? You're buying and selling at a future date at fixed price. OTC equivalent of future contracts that can be customized. So they are traded on over the counter, they are not traded on exchanges, and they are extremely customized. Next is future. Future contract is an exchange traded contract. So difference is they are exactly same as forwards except they are traded on exchanges. Exchange traded forward agreements between two parties in which one party is obligated to buy and the other party is to sell an underlying asset. So they are standardized in quantity and quality. They have an agreed price upon today and they generally execute at a future date. Now future contracts have margin requirements. So there is initial margin, so the margin that you have to deposit if you want to get into a contract, and you have to keep a maintenance margin also, the minimum account balance that must be maintained if the contract is open. So how it works, as a buyer and as a seller, you put in initial margin to trade. If you make profit, the margin goes up. There is mark to market. So if you are making profit, the margin value goes up. If you make losses, the margin value comes down. Now there is a minimum level that you have to maintain. If due to losses you hit the minimum level, you get a margin call. You have to either increase the margin or close the trade. Both are set by exchanges on which contract trades, but firms may generally impose higher rates on clients. Now there is a concept of mark to market. So daily settlement of gains and losses happens. So changes in price of the contract from the previous day will lead either to a payment by the long position to the short or vice versa. So either the buyer pays or the seller pays depending on the price movement. Payment is not made directly between the long and short, but is instead between the counterparties, so respective investment dealers through the clearing house. So there is a clearing house who guarantees the trade. Why buy future contracts? Investors buy future contracts either to profit from an expected increase in price or to lock in the purchase price. So if you're buying certain stocks and you want to lock in the purchase price, you can buy a future contract. If you're selling certain stock in future, not right now, but you want to lock in a certain price, you can sell a future contract. So you can either speculate or you can cover your risk. So investors buy future contracts either to profit from an expected increase in the price of the underlying asset or to lock in a purchase price for the asset on some future date. Speculation, it is attempting to profit from an expected increase in the price of underlying asset. Risk management, it is locking in a future price for the asset. Why investors sell future contracts? Investors sell future contract to profit from a decline. So buyers profit when price goes up, sellers profit when prices decline, or to lock in the sales price of a particular asset on some future date. So speculation is attempting to profit from an expected fall in the price, and risk management is locking in the future price for an asset. Now exchange traded and OTC derivatives. Derivatives trade either on an organized exchange as exchange traded derivatives called as futures, or they trade off an exchange called as over the counters or forwards. OTC network is dominated by banks and financial institutions who trade directly with corporate clients and other financial institutions. When a forward based derivative trade on an exchange, it is typically called a future contract. Now this is difference between exchange traded and OTC. So exchange traded, that is futures, they trade on exchange. OTC contracts trade through computers and or phone lines, so they trade majorly on the dealer network. These are standardized contracts, so standardized in terms of quantity as well as quality. OTC are extremely customized.